All right, folks. Today, what we're going to do is we're going to learn how to account for taxes. Now, prior to 2010, okay, we had two taxes. We had the GST, which was the federal government tax of 5%, and we had the PST, which was the provincial government tax of 8%. So basically, the province was getting more than the federal government, okay, when it collected the taxes at that time. Now, it hasn't changed much uh, since 2010, outside of the fact that we only have one tax now. It's called the HST, or the Harmonized Sales Tax. Okay, so what ends up happening is, instead of collecting two separate taxes, okay, the GST and the PST, and one is sent to the federal government and the other one sent to the provincial government, what ends up happening is the province collects the HST and then sends it to the federal government, and the federal government then divvies up what belongs to them and what belongs to the province, and they'll send the province their share. Now, GST stood for goods and services tax, right? Okay, it didn't stand for general sales tax, it didn't stand for government sales tax, okay? It stood for goods and services tax, okay? Now, again, HST stands for harmonized sales tax, and it represents 13%, and it includes both the provincial and the federal shares. Now, HST is applied to most goods and services. Okay, in university, there's an entire course on taxation, and there's many rules regarding taxes. So we're just going to scratch the surface. Now, at the end of each quarter or every 3 months, the HST collected, or it's the account's called HST charged on sales, is reduced by the HST that we pay out as a company, and that account's called HST paid on purchases. So basically, what that means is we're going to send the government what we collect in taxes less what we paid out in taxes to make purchases. If we purchase equipment, okay, we have to pay taxes on those materials as well, right? But the government says, since we're a business, they'll they'll refund that money back to us. So basically, what we're going to do is we're going to send them the difference, we're going to send the government the difference between what we collected in taxes and what we paid out in taxes. And that process of sending what we owe is called remitting. Okay? Okay, so again, the taxes a company collects from selling goods and services, okay, are recorded in a separate account called HST charged on sales, or HST payable, right? Payable because it's a liability. Like the taxes we collect, we don't own. It's not our money. It's the government's money. So we have to pay it to the government. So it represents a liability to us. So HST payable, or in other words, HST charged on sales, has a credit balance because it's a liability. Now let's see how this affects a transaction. So let's assume that on January 1st we sold a fitness membership worth $300, okay? And we're going to account for HST. So if we sold that membership for $300 cash, our cash is going to be debited $339. Why? Because we're going to get the $300 for the membership and then an extra $39 in taxes. So total, they're going to give us $339. Now, our revenue account, membership fees, is going to be credited for $300, and HST payable, okay, a liability, is going to be credited for the remainder, $39. Now, let's look at a transaction where instead of selling something, we're actually buying something. Now, by comparison, a company is charged taxes when it purchases things. The money it pays in taxes is returned to the company by the government. Now, we're going to record the taxes we pay out when we buy stuff into an account called HST recoverable or HST refundable or HST paid on purchases. Now, the thing about these accounts are, or not these accounts, but this account, okay, is that it is not a liability, it is a contra liability. Now that's new for us, and what that means is any contra account is an account that reduces another account. Now remember what I said when I told you that when we remit taxes or send them to the government, we're going to reduce HST charged on sales by HST paid on purchases. So HST paid on purchases is contra to HST charged on sales. Okay? So it's going to reduce that liability account HST charged on sales. Now, here's something to remember. A contra account will have a balance opposite of what it is contra to. So HST paid on purchases is contra to HST charged on sales. Now, HST charged on sales is a liability. So a contra liability would have a debit balance because the liability has a credit balance. Now, it's going to be listed in the liability section of a balance sheet, but it has a debit balance. So what do we do with it? So when we record it on the balance sheet, it's going to have brackets around it. It's going to look similar to this. So all your liabilities will be here. So accounts payable 1,000, HST payable or HST charged on sales is a liability, so it doesn't have brackets around it. HST recoverable or refundable or HST paid on purchases, it's a contra liability. So it has a debit balance. So we're going to put brackets around it because it's going to be subtracted from all these other liabilities. Now let's look at how HST recoverable or refundable is recorded. So let's assume that on January 1st, we purchased $100 worth of equipment on account. So the equipment is going to be debited for 100. We will be owing $113 because we owe the 100 plus the $13. Now, remember I said HST refundable or recoverable or HST paid on purchases is a contra liability. So it's going to have a debit balance. So if you start here with equipment and you think about how much you owe, you should be able to arrive at the fact that it's got to be debited. Okay? So outside of that, that's the lesson for today. I hope you understand what I'm kind of telling you without me being there, but unfortunately we have to deal with these changing times. All right? Hope you do well.